Good morning, guys. Today I'm going to be doing shares and dividends. However, I will be focusing on dividends more as we've done shares in the previous videos. Question is, what are dividends? Dividends are returns to the shareholders for their investment in the business. So whenever you put money into something, you expect a return from that thing. So when you buy shares from a company, note that you are giving the company your money, and in return of your contribution, you expect some sort of a return, and that return will be called dividends. Remember, to be a shareholder, you need to have bought shares from the company. You need to have a share certificate reflecting the number of shares you own in the company, as well as the price you paid for those shares, right? So you have the shares and the business has your money. Once the business has issued shares, those shares are in the hands of the shareholders, and the business has the money from the shareholders. Dividends are calculated as a percentage in cents of the number of shares issued, or a percentage of share capital. Please note that you calculate dividends on the number of shares issued or share capital. Share capital is simply a calculation of the money you receive from the shareholders. So you only receive that money once you have issued shares. I emphasize this: shares, dividends will only be calculated on the number of shares issued, or simply your share capital, which is just your shares issued multiplied by the share price. I repeat, dividends may only be calculated on the number of shares that have been issued. It will be given to you as a percentage, or it will be given to you as cents. Cents are simply the same as a percentage. 200 cents, you simply take those 200 cents, you divide by 100 to determine the value of your dividends. Remember, your share capital is simply the number of shares multiplied by the share price. What is declaring dividends? Declaring dividends is when you you declare to your shareholders that you are going to give them a return, and that return will be your dividends. Now, before a company may declare dividends, liquidity and solvency ratios must be met, meaning that the company must be able to settle its short-term liabilities, and it should also be able to settle its long-term liabilities. Liquidity, it is the ability of the business to settle its short-term debts. Solvency, it is simply the ability of the business to settle its long-term debts, basically its financial obligations. Once the company declares dividends, it is obliged to pay those dividends, so it has created liability. We have two types of dividends. We've got interim dividends, which are dividends that are declared and paid. So these dividends, we don't owe them. We don't owe shareholders these dividends. We declare them, so we're telling shareholders that we're going to pay you these dividends. We have a contractual obligation to pay you these dividends, but we will pay them immediately. So we declare and pay. All right, so there's no liability that is created by interim dividends. Remember, you need to check when you declare interim or pay interim dividends, and when you calculate those interim dividends, it needs to be calculated on the number of shares that have been issued. So you need to check at that date when you declared interim dividends, how many shares were issued, or you can simply take your share capital on that date. Final dividends. These dividends are only declared by the company at the end of the period, or simply towards the end of the financial year. However, these dividends are only declared. They are not paid. They will simply be paid in the next financial year. In one financial year, a company only pays, I repeat, a company pays only two types of dividends. A company pays only two types of dividends in 1 year. It pays last year's dividends, It pays last year's dividends and this year's interim dividends. However, a company only declares two types of dividends in one financial year. It declares interim dividends, which I've explained, and final dividends. Please replay what I've just said because I said two different statements and they have a very huge effect because students make mistakes because of those statements that I've made. A company only declares two types of dividends. It is your interim and your final. So your this year's final dividends will only be paid in the next financial year. They are classified as current liabilities. So your final dividends are classified as current liabilities and they'll be recorded in note 9, and that is your trade and other payables notes because we will only pay it in the next financial year. However, interim we declared and paid. We don't owe interim dividends. What are dividends on ordinary shares? Dividends on ordinary shares are simply the total dividends that you have declared. Dividends on ordinary shares are simply your total dividends that you have declared. Remember I said we only declare two types of dividends. It is your interim dividends and your final dividends. This year's interim dividends as well as your final dividends for this year. Those will only be the dividends that you declare in one financial year. Dividends on ordinary shares are simply your interim dividends plus your final dividends. Dividends on ordinary shares are simply your interim dividends plus your final dividends. Then we have retained income. What is retained income? These are simply unused profits that we will use in the future to pay dividends and tax. We can actually use these unused dividends, unused profits to actually buy back shares in the future. So we basically will use them in the future. We haven't used them up to this point. So these are profits that we do not use. We're going to use them in the future to pay dividends as well as tax. These are accumulated amounts of profits that the company has not used over the years since from its inception. So they accumulate, they add as much as whenever you earn profits and you haven't used those profits, you add those unused profits to last year's profits until it creates what we refer to as retained income. So they accumulate as we earn more profits and we don't use those profits. This is the example that I'm giving you. It says Veritas Limited was founded on the 1st of March 2018. Its financial year runs from the 1st of March until February. Veritas has 5 million authorized shares as stated in its Memorandum of Incorporation. Balances on the 1st of March 2019. We've got share capital of 2 million. However, the number of shares that were issued on the 1st of March 2019 will be 600,000 shares. So out of the 5 million shares, we've only issued 600,000 shares. We've got retained income, which is a balance of unused profits at the beginning of this current financial year. So unused profits will be 500,000 rand. Now shares, the company issued 500,000 shares on the 1st of April on 2019 for 250 cents per share, and then we received 1 million rand for shares issued on the 30th of January 2020. These shares were issued at 5 rand per share. Dividends. The company declared interim dividends of 60 cents per share on the 30th of June 2019. The company declared final dividends of 40 cents per share on the 28th of February 2020. You need to pay attention to the dates because the dates are very important. You actually have to determine how many shares were issued before that date when the dividends were declared. However, there's something that they specify that shareholders who bought shares on the 30th of January 2020 do not qualify for final dividends. So when we calculate final dividends, we do not include dividends. We do not include shares that were sold on the 30th of January. So those shares do not qualify. So they do not get final dividends. They do not get dividends. Those shareholders that bought shares on the 30th of January 2020 do not get, they will not get final dividends. Now, this is how we're going to work this out. You're going to prepare your ordinary share capital note. You're supposed to know this by now. We have 600,000 shares in your share capital. Will be 2 million at the beginning of the years and then of the year, and then we will issue 500,000 shares at 250 cents per share, which will simply give us 1,250,000. Now, how did I get that 1,250,000? You'll simply take 250 cents and divide them by 100, and whatever you get there, you'll multiply it by 500,000. It'll give you 1,250,000. And then we issued 1 million shares at 5 rand per share, and that will give us 2 million. It should actually give us 5 million rand. At the end of the year, you will have 2,100,000 shares, and your share capital at the end of the year will simply be 8,250,000, which is 2 million plus 1,250,000 plus 5 million. It'll give you 8,250,000. This is something that you haven't done. It is what we refer to as retained income, where we will simply determine the amount of unused profits. So your retained income will start with the balance at the beginning of the year. In this case, the balance at the beginning of the year was simply 500,000 rand, and you will put in your net profit after tax. Please note that in our example, we are simply given our profit before tax. For us to determine profit after tax, I'm simply going to take that and multiply it by 72, because they said to me our tax rate is 28%. So it means profit after tax will be at 72%, because our tax rate reduces our profits, because tax rate is an expense. It represents what we have to pay to source, all right? So it reduces our profits. When you take 100% of our profits and decrease it by 28%, we will be left with 72% of our profits. So for us to calculate our net profit, I simply took 1,500,000 rand and I multiplied it by 72, and I divided by 100, and it gave me 1,080,000 rand. The next item in our retained income will be lost due to buyback of shares. You're going to put this in brackets. Normally, this will be when your buyback price is more than your average price per share. It means you paid more than what you received. You paid shareholders more than what you received. That difference will be the one that you record here. I've already taught you guys how to calculate your loss or your profit from the buyback. If it was a profit, it will not be in brackets. If it is a loss, you simply put it in brackets. If it was a loss, you will simply put it in brackets, as I've indicated. And then we've got dividends on ordinary shares. What did I say dividends on ordinary shares will be? It is simply your interim dividends as well as your final dividends. Now, for me to calculate my interim dividends, I need to prepare my timeline. My timeline will start on the 1st of March, and I only look at the number of shares that were issued, because dividends are calculated on the number of shares issued. At the beginning of the year, there were 600,000 shares that were issued. I declared and paid my interim dividends on the 30th of, on the 30th of June. However, I issued additional shares on the 1st of April 2019 that will increase the number of shares that were issued. By the end of April, or by the 1st of April 2019, I'll have 1,100,000 shares issued. All right, these are the number of shares that were issued. I declared my interim dividends on the 30th of June, and for me, at that date, I had 1,100,000 shares issued. So basically, I'm going to be calculating my 60 cents of my interim dividends from the shares that were issued on that date, which will give me 660,000 rand, and that will be my interim dividends. Make sure you show this calculation in bracket, and obviously, it'll give me 660,000. I declared my final dividends on the 28th of February 2020. I will write the 28th of February 2020. However, you need to know that I issued shares on the 30th of January, and I issued 1 million shares. I was going to add them. However, I cannot add these shares even though I have 2,100,000 shares issued on that date. I can't use that 2,100,000 shares because I've been told that I've been told that those shares do not qualify for final dividends. So I will simply exclude them when I calculate my final dividends. Hence, I will actually highlight them in red. It means that it's danger. I'm excluding those dividends. I will simply be left with 1,100,000 shares. So I will simply calculate my final dividends on 1,500,000 shares. Had they said nothing, please note I was going to calculate my final dividends on 2,100,000. But because they specify that those shares that were issued on the 30th of January do not qualify for final dividends, I will simply calculate my final dividends on 1,100,000, which will give me 440,000, and those will be my final dividends. My final dividends will simply be 440,000. You added these two, they will give you your dividends on ordinary shares, and you will put that in brackets. Dividends decrease the amount of unused profits, the value of unused profits. So you're going to take 500,000, add it with my profits for the current year, my net profits for the current year, and then subtract my dividends on ordinary shares. It will give me my unused profits at the end of the year, which is the 28th of February 2020, and my unused profits will simply be 480,000. The only thing that I'm left with is my ordinary, it's my trade and other payables where we record shareholders for dividends. These are final dividends for the current year. From the previous slide, you'll realize that our final dividends were 440,000, which is over there. Those dividends will not be paid this year, they'll only be paid next year. So I will put them in trade and other payables, which is 440,000. And as I've indicated, these shareholders will not pay those dividends. They'll only be paid in the next financial year. In the current year, we will treat them as current liability. Classwork 1, I will send it shortly to you guys. This is classwork 1. Please do it. It is due on at 6 p.m. as I always say.